I would expect this market to kind of cool its heels here a bit, where overbought, we're extended from the 50-day moving average pretty decently. And when you kind of get deviated too far from these moving averages, they act like gravity. Eventually, you're going to get a reversion back to or back through that moving average. So that 50-day moving average right now is acting as a bit of gravity. So I wouldn't expect a whole lot of upside from here. We could kind of grind a little higher here, but I would expect that between now and probably by the time we get into mid-June, that we may see a little bit more consolidation here or a light correction back towards that 20-day moving average and reestablish that 20-day moving average is kind of the trending run line that'll take us into potentially August. Now, once we get into September, October, I would expect to see a bit bigger correction, probably something akin to what we saw in April, maybe a little bit bigger, something more like we saw last summer of 10% as we head into the election, just because of the uncertainty of outcomes.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back at the end of another week, joined by my good friend, the strumming and plucking Lance Roberts. How you doing, Lance?
It's more like swimming and paddling this week. So
really, is it still super stormy and rainy there in Houston?
Well, no, we got through that. So I lost my power. I was doing it from the office last week. Had no power. We had power at the office, but not at home. And so I did figure out how to fix power. So that was the exciting news over the weekend. So we had lost our power. And then on Saturday, I went to the office to do a little bit of work. And so I called my son and I said, hey, I'm going to swing by the house. He's hanging out in the house, pitch black, just sleeping. And so I said, I'm going to come pick you up, take you to lunch. And so, there's a Slotsky's restaurant too far from our house. If I guess you know what Slotsky's is, it's a sandwich shop.
Okay, if you say so.
Yeah. So anyway, they make sandwiches. And he loves sandwiches. So I picked him up. I said, hey, we'll go grab a sandwich. So we went to Slotsky's. And by the time we got back home, our power was on. So, he's like, oh, great. If you go to Slotsky's, your power comes on. But we survived. And then this whole week, it's been a good bit of catch up. So
all right.
It's all fine. All around me, trees were, the devastation was pretty amazing. I don't know if you saw any pictures of it, but, trees through houses, trees through $100,000 mobile homes, that type of stuff. So
yeah, I saw a lot of pictures online. Just skyscrapers with their windows smashed.
Yeah.
Stadiums that were super compromised and damaged. But you sent me some photos from your street, and there were just some massive trees down in the houses there.
Yeah, and it's a shame, because those trees have been here for 100 years or whatever. At least 60 in some cases. But yeah, so you lose some of these massive old oak trees. It's kind of a sad thing, but they were all. I haven't seen this much destruction of trees and things like that since Hurricane Harvey back in 2017.
Well, and that was the weird thing about the storm, right? You had like 100-mile-an-hour wind gusts. Those are hurricane force winds.
Yeah, but it wasn't a hurricane. It was just a thunderstorm.
So. I know, that's why it was so weird. Anyways, glad you made it through okay. Yeah. I chose strumming and plucking because I figured with the power off, you had little else to do but take out your guitar. Wanted to let folks know that you were a guitar player. And I went with strumming and plucking because I went online trying to find an interesting term for guitarist. The only other one was plank spanker. And I figured you probably didn't want that one.
This is true.
All right. Well, look, lots to talk about this week. Real quick from the very beginning, I don't believe this is the week we're going to do the simple visor overview, right? Just to keep people, still dangle that carrot in front of them. But I don't want to disappoint them by telling them that an hour into this thing.
Yeah, no. It's we had finished up all of our API connections. I am now in the process of having web developers actually develop the portfolio structure for the website. So hopefully in the next 2 weeks, in theory, everything will be good to go.
Okay, great.
Everything's ready. It's just a little bit of technical connection thing that we've got to finish up.
Yeah, and sorry, folks, for the longest tease ever here. I'm sure it's going to be worth the wait. But yeah, just wanted to make sure folks know we weren't going to get into that deeply in this conversation. Also, just a reminder to folks, we now have less than 10,000 subscribers to go on this channel before we hit the 100,000 subscriber mark. And Lance, when we do hit it here on the Saturday weekly market recap with you, I will do a live unboxing for folks when we get that special plaque from YouTube that commemorates that milestone. But
Nice.
anyways, folks, if you're watching, there's at least 40, 50,000 of you watching this video. If you can help us get to that 10,000, that 100,000 milestone by clicking the subscribe button below, as well as that little bell icon right next to it, I'd very much appreciate it. And I'd love to hit it before the end of July. I'd love to hit it sooner, but I'd love to hit it before the end of July because that's my birthday, and that would be a great birthday present to hit that before then. But hopefully you'll deliver that way before then.
Shameless plug on you.
No, it's okay. It's okay. Nobody needs to get me anything except the subscribe click. Easiest birthday present ever.
And if you don't subscribe, shame on you. It's all your fault.
All right. Well, look, interesting week, Lance, because at some point this week, all the major stock indices hit all-time record highs, right? The day before we're recording this was an interesting day in the market because everybody thought it was going to be a great day because Nvidia just crushed earnings and revenue expectations as it has again and again, and the stock was up, something like close to 10% in the aftermarket going into the pre-market going into the day's trading. And then basically the wheels came off the markets. Nvidia ended up being like the only stock up for the day.
Yeah.
See a red otherwise. And it was because we got good news. And we're at that point now where, we've been to the point where good news was good for the markets and bad news was good for the markets. Now we seem to be getting to the point where good news is bad news for the market. And this was US PMIs, right? They came in stronger than expected. It made everybody think, man, that's going to make it harder for the Fed to do its rate cuts. And therefore, markets took that as bad news and sold off pretty hard.
So, yeah, no, it's true. And these were the S&P global PMIs, which, they're not as relevant as ISM manufacturing PMIs. Those are much more relevant to the markets. But now the market's just looking for any bit of data. So whatever piece of data comes out, the market kind of just latches onto it. The computer algorithms go crazy, and then you get a bunch of movement in the markets. But it's interesting because whatever good news that was bad news yesterday is reversed on Friday, because on Friday, the markets have basically recovered all of that decline. So what really happened, now let's talk about the real story about what happened, is that we've been writing about this for the last week. So as you know, we put out a daily market commentary every morning, comes out at 7:30 a.m. Central Time, emailed to your inbox. So you have to do a subscribe. And every day we put in, we have some talking points about what kind of things are going on in the markets, but we do a market update every day about the S&P and kind of what the trading is expected to be, kind of for the day and kind of where we are, as you and I do here. We look at the chart, we talk about what that means. And for the last week or so, we've been saying, hey, the markets have gotten back to extremely overbought. We've been consolidating now for about a week. Expect to have a bit of a pullback here towards that 20-day moving average. It'll be very short-lived, but look for a correction. All that's needed is just some piece of news to allow traders to take money off the table. That's all that happened yesterday. So you had a very quick trip down, reverse some of that overbought condition, not a lot of it, but some of it. And when you're in a strong bullish trend, those one-day sell-offs are about typically all you're going to get. So that's your kind of opportunity to add exposure if you want. But that's all that happened yesterday. Was you had some news that triggered an overbought extended market to have a bit of, traders went, yeah, I'm going to take some money off the table here. And that's what happened. So, and again, now that's reversing on Friday.
All right. So we'll pull up the charts in just a second here so you can kind of show us where we are versus overbought territory and the daily moving averages. Real quick, let's just talk about Nvidia for a moment, just in case there's anything else that you want to say about it. It does continue to be, the wonder stock. It continues to be the stock that kind of drives the market, yesterday being the exception. I think it's 5% of the market cap of the S&P.
Yeah, it's up there. Yeah, it's up.
It's now 2.5 trillion. That's more than Germany's stock market cap.
Yeah.
So it's gotten unbelievably huge. You know, it's an amazing story, right? I mean, it's just kudos to the company for positioning itself so well, so that when it sort of hit this gusher of opportunity, it is capturing the vast majority of it right now. In fact, I just mentioned on Twitter the other day that I had lunch recently with a friend or an acquaintance who runs a business, runs it out of his house, and he basically manufactures a component for data centers.
Huh?
And he is it's like Jed Clampett. I mean, it was
Yeah,
a business that did pretty well, but it has been gushing orders from Nvidia and its
yeah,
other AI components. And he says, look, I know it's not going to last for very long, but I'm just not sleeping because this is the time to just get all the fish in the boat, you know, while they're jumping.
that's right.
So there's this, you know, massive, you know, commercial demand for this stuff. Who knows how long it's gonna last? But the estimates I keep seeing about just data center buildouts keep getting up in terms of what's going to need to happen for all the plans that all these, you know, corporations have to invest in AI. So, anyways, you know, everybody loves Nvidia. It's the stock that keeps going up. I heard a great quote from Ronnie Stafferly, who I interviewed the other day, where somebody else said it, but he was the first one to tell it to me. And he said, yeah, well, you know, the world we live in now with Nvidia, he's like, he said, Nvidia is like Taylor Swift for dudes.
Yeah.
So it's just like everybody loves it. It's just the global phenomenon, right? So, you know, I guess I just want to hear any thoughts you have about Nvidia. I know you have some in the portfolio. I'm sure you probably wish you had more coming into this year. But, you know, trees don't grow to the sky. You know, at some point, a company this big just can't grow that much anymore because it's so massive. So where do you think we are in the Nvidia story?
Still early. You know, you're looking at a company that's going to grow to 144 billion in revenue next year. So here, let me just, well, here we can do some quick kind of look at some analysis here. Give me 1 second. So this also is going to feed into our kind of our trades for the week. The only trade we made this week was on Nvidia. And what we did is we had bought Nvidia previously. It had a big run going up into January, February, March, and was very overbought. We expect to have a correction, so we reduced our position a bit in March, and then had the correction going into April. We added back to our position in April, and so going into earnings, we had seen a couple of things going into earnings with other companies, like Palo Alto Networks was a good example. It's another stock that we own. And they had announced really good, they beat earnings, they beat estimates. The problem was guidance was in line with estimates. They basically came right in line with what Wall Street was wanting. And the stock was down at the open about 8%, recovered most of that during the day. But you know what that, you know, where we are in this market is that if companies don't just slaughter earnings, but most importantly, not just beat earnings, if they don't really raise that guidance, that forward guidance going out,
Right.
stocks have been just brutalized over this last earnings season. In fact, companies that beat earnings were moderately rewarded. But companies that missed earnings, they were just, you know, just beat to death. And so in our daily market commentary on Wednesday, so this was Wednesday morning before the earnings came out, we posted out some analysis in that daily market commentary saying, okay, here's our expectation for Nvidia. We think they'll beat earnings. We think they'll raise guidance. The upside to that stock is 10%. The downside is 20%. If they miss or even just disappoint on guidance, that stock will be down 20%, you know, in the day. So that's why we're taking some profits out of the position that we had added on, you know, added that position back in April. So we took those profits, and sure enough, the next day they announced earnings. Guidance was fantastic. The stock was up 10%. Almost to the T. It was 9.94, so we missed it by a hair. But that was the risk reward now. So we had a 2-for-1 downside, you know, versus upside. So it made sense to take some money off the table. And again, so the stock is fairly stretched here. And you know, there's certainly some ability for, you know, the company continue to do well. And we've also got an article coming out next week, and that we can talk about here on the show in particular, that is the future of what AI means, not just for the market itself, but for the economy. And what does that look like for the overall economy going forward? And so there's some very important things that are going here that are happening. So if we take a look at earnings for Nvidia here on the left-hand side, you'll see that EPS for the current quarter is 582, next quarter is 637. But look at the bottom. Revenue is expected for next year to be $141 billion in revenue. In next year, earnings per share next year are going to jump from 637 to $24 a share. That's massive growth for the stock. And so you've got a stock that's trading below its median 5-year valuation right now. This is a tech company. It's in the middle of that big growth stage. This is Apple 20 years ago, where they're just coming. Actually getting came out with iPhone in 2007. So, you're just hitting that big growth phase for Nvidia. So this growth in the stock can last a whole lot longer than people expect. And this is going to be the one challenge for a lot of people, particularly people trying to short the stock and expecting kind of an end to this growth rate. It's very early in this cycle. Now, a big chunk of the growth is likely in the stock. What will help that growth a bit in terms of the price will be the 10-for-1 stock split that they announced, because that will now allow people to actually invest in stock at lower dollar amounts. This is an interesting problem. For example, in our portfolio, we run the portfolio we run on SimpleVisor is a live account. So I funded it with $100,000, and I said, okay, we're going to run this model. And so if you have $100,000, you can actually just replicate that model. Well, the problem is with a stock that's $1,000 a share, $1,000 is 1% of the account, right? So, all I could buy was one share of Nvidia for 1% of the account. So if I wanted Nvidia to be 2% of the account, so I could own 2 shares, right? So we bought this a long time ago. So we actually own like 4 shares now, but because it's been growing over time. But the problem comes with trying to risk position a investment into your account when it's a very high dollar stock. AutoZone is another good example of that. AZO, it's a $2,800 stock. So if you want to buy one position in your portfolio, it's almost 3%, just one share, right? So trying to risk size these very high dollar positions in your account become challenging when they're $1,000 or $2,000, or like Amazon was before, $3,000-$4,000. It's very challenging. So this 10-for-1 split now allows managers like me to buy more shares, because now I can have a 2.5% position, or a 3.5% position, or a 3.25%, whatever I wanted it to be. Because now with those smaller dollar values of that split, it allows me to buy more shares, but I can then still risk size it within portfolios. So that's going to help both the retail investor as well as professional investors continue to buy the shares of the stock as it goes forward. So it provides some liquidity to the overall market.
Okay. Can I ask it's probably a naive question about that,
Sure.
which is, I remember several years ago, hearing all the news. I think Robinhood was sort of at the forefront of this, of letting you buy fractional shares.
Yes.
Right. So, companies like Berkshire Hathaway, right, famously, they don't split shares, right? So the share price gets super high. So this was sort of touted as, well, hey, you can just own a slice of it now going forward, right? Yeah. Has that not kind of become the industry standard, this fractional share?
It's still fractional shares are still out there. Retail investors can buy fractional shares, like on Robinhood, even on Fidelity, you can buy fractional shares. We can't buy fractional shares.
Okay, that's the question I was going to ask.
Yeah, because as an institutional player with Fidelity, who is our custodian, we don't buy fractional shares. So it's just because we buy such large blocks of stock at a time that we don't need to buy fractional shares. But see, the problem with fractional shares, what people don't understand is that when you buy fractional shares, it really works against you, because the actual trading does not happen in fractional shares. So what has to happen is, in this case, let's say, i.e. Robinhood as an example, and Adam, you want to buy 5/10 of a share of a stock. Well, they can't buy 5/10 of a share of stock in the open market. So what they have to do is they have to wait until they can accumulate enough shares in order to execute a block trade of 1,000 shares or 100,000 shares or whatever it is. Citadel, who they sell sell the order flow to, will only buy in big blocks. So you lose time waiting so the price can be moving on you while they're waiting for enough shares to accumulate. Then Citadel sees the price of the share that's coming in. So Citadel can position that trade in the overall market. They can short against it or go long against it as that trade's coming in. So that's how Citadel makes money. And that's why Citadel pays order flow fees back to Robinhood, which is how they make money, because now when they can see that order coming in, they can kind of front run that order in order to make a profit, which also hurts your execution at the end of the day. And so even though trading is free, so to speak, and you can do these fractional shares, that actually winds up costing you more than just if you paid a commission and bought a whole share, you would actually come out better than doing fractional free share trading.
Interesting. Well, as they say, when it's totally free, oftentimes that means you are the product, right? And you're not getting as good of a deal.
There is no free lunch on Wall Street, period. So,
all right. So when it comes to Nvidia, are you, given how you laid out that you think it's Apple 20 years ago, are you guys in an active accumulation phase at this point in time, or are you more being opportunistic, like waiting for big pullbacks to add?
Yeah, no. The stock will definitely have a 20-30% correction again. I mean, it just had a decent correction just a couple of months ago. So for the stock to correct, 20% from here, it's no big deal for the stock price. I mean, it's because it is a high growth stock. The 20% correction. One piece of bad news. There's actually an interesting piece of news that Nvidia out today that they're going to have to slash the prices of GPUs to compete with China,
right.
and so that's going to hurt future profits down the road if they have to drastically cut the share costs. And there's also, ultimately they're going to be a victim of their own success at some point. So as they're becoming more successful, that's going to, as we talked about before, the way capitalism works is somebody somewhere, some young person is sitting at home right now going, you know what? I could build a better GPU. And they're going to come out with a better GPU that they can sell at a cheaper price. And eventually Nvidia will have competition that will eat into their market share, and that will eventually slow the growth. But that's going to be, several, 3, 4, 5 years down the road. And something certainly well to pay attention to. But if you take a look at this, is the growth of their earnings per share versus their stock price. And again, not surprisingly, the stock is going to continue to track that growth in their EPS. So if we take a look at this on a 5-year annualized pace, you can see this very sharp uptick in earnings growth.
Sorry to interrupt. I'm not sure they are, but are they doing buybacks like the other big tech companies?
They're doing some, but not nearly to the degree. They don't need to yet.
Yeah, exactly.
But I am sure once they start seeing a slower spate of EPS growth, that stock buybacks will start to become a bigger factor for them.
Okay. All right. So for RIA,
basically to answer your question, here, this is the shares outstanding for the stock versus the stock price, and you see that basically the shares outstanding are flat.
Okay. So from RIA's portfolio management perspective, when it comes to Nvidia, again, are you on a sort of, steady Eddie accumulation schedule, or are you being more opportunistic, looking for entry points?
And so, right. So like, for instance, as I said, before, is that we've owned Nvidia for a while. Nvidia is fully weighted in our portfolio. So if you take a look at our portfolio, so we weight the portfolio based on how much risk we're willing to take in a position. So if for instance, with public storage as an example, we just added that one recently. And so, we added a very small percentage starter position. We're looking for that one to correct. It was a bit overbought. It's in that process now. We're down about 5% from where it was. We're kind of looking for this thing to pull back around 10%. Then we'll add to that position. So that position will ultimately be 2.5% of the portfolio. So when you get down to Nvidia, Nvidia, as an example, is currently 2.24% of the portfolio. Here it is right here. Actually, the target portfolio weight is 2%. So it's already, because of that run up it had, on Wednesday, it's a little bit overweight relative to its target. Now, again, at $1,000 a share, I can't take profits in it here, because if I take $1,000 stock out of the portfolio, I'll have a 1.25% position, not a 2.25%. So I am unable to take profits here and reduce it. Now, once it goes to $100 a share, it'll be much easier, right? But that's probably about the most it's ever going to weigh in the portfolio, because we're also running at the same time AMD, which is its direct competitor. So we own both stocks in that sector. AMD's had a fairly decent correction here, and we're probably going to be looking to add to that position a little bit here in the near future, and kind of keep managing these two companies as we go forward, because they both play in that chip production space.
Okay. All right. Okay. So you're fully weighted, basically.
Yeah.
Hey, real quick, Palo Alto Networks. I remember you bought into that stock after it had that disastrous earnings call where Wall Street didn't like the guidance it gave. I think the stock was down 20%. I'm just curious, how has that played out for you?
We're up 17% in the position now, and we've added to it since then. So we bought it right at the lows. The stock rallied a little bit, pulled back again. We added to it. So so this is a great example, right? If we take a look at Palo Alto Networks on a transaction basis, let me I'll show you kind of how this works out. So we bought it originally on that initial dump. So the stock was down a good bit. So we bought 3 shares at that point of the stock. It rallied a bit, it pulled back. We added, basically doubled the position size at that point. So now it's about 1.6% of the portfolio. It's going to be its target weight. We might add a little bit more to it. It might become 2. But right now at 1.5 to 1.6, that's a good weight for that position. So we're up about 17% in the stock. So it's doing kind of what we planned for it to do.
Okay. All right. I got to start moving on here, because as usual, we're on like my second bullet here.
Got it.
Well, first, I guess before I get to this next question, can you just pull up the general S&P chart that we look at and just sort of tell us where we are relative to the moving averages and the Bollinger Bands? And, I think the last time we talked, we were probably still in overbought territory, but.
Oh, yeah. Well, we're not as much overbought. So again, here's this little dip right here is that sell-off yesterday that you were talking about.
Yeah.
Again, it's kind of hard to see, but we had the sell-off, and again, it's kind of the market really hasn't gone anywhere for about the last 2 weeks. We're just kind of trading sideways, and that's beginning to work off some of this little previous overbought condition. And we're close to triggering a real short-term little sell signal here. So if this market kind of keeps grinding sideways for the next few days, or has another sell-off for some reason, we're going to trigger that sell signal. And that would just suggest that likely we're going to come down and retest this 20-day moving average, which is what I would expect to happen. If you go back and look at this entire run that we had from October of last year to March, we just basically ran right along that 20-day moving average. So every dip to that 20-day was a good entry point to add some exposure if you needed it. Eventually, when we took that out, we triggered this sell signal, took that out, and then, of course, that's where we tested the 100-day moving average. We then flipped that buy signal, that sell signal, back to a buy, and that was kind of the entry point to get back into the markets. So again, I would expect this market to kind of cool its heels here a bit, where overbought, we're extended from the 50-day moving average pretty decently. And when you kind of get deviated too far from these moving averages, they act like gravity. Eventually, you're going to get a reversion back to or back through that moving average. So that 50-day moving average right now is acting as a bit of gravity. So I wouldn't expect a whole lot of upside from here. We could kind of grind a little higher here, but I would expect that between now and probably by the time we get into mid-June, that we may see a little bit more consolidation here, or a light correction back towards that 20-day moving average, and reestablish that 20-day moving average is kind of the trending run line that'll take us into potentially August. Now, once we get into September, October, I would expect to see a bit bigger correction, probably something akin to what we saw in April, maybe a little bit bigger, something more like we saw last summer of 10%, as we head into the election, just because of the uncertainty of outcomes.
Okay. All right. And you've mentioned that many times before here. So as we get closer, then we'll see. But obviously, the reason for that is because markets don't like uncertainty. It's likely to be a close-ish or at least hotly contested election.
Yeah.
Folks are going to want to seek some safety on the sidelines to see what happens after the dust settles from that.
And again, look, any prediction more than about 5 days out is completely useless. So I can pretty much tell you what the market will do next week. But, once you start talking August, September, October, nobody really has a clue. So it's just, looking at seasonal statistics, look at history, typically going into a presidential elections, and potentially as one as contestable as this one, Wall Street tends to take some bets off the table just in case.
Yep. So totally agree with you. I do want to, though, mention tomorrow's video on this channel is with famed technical analyst Tom McClellan. His family developed the McClellan oscillator. I love looking at Tom's work because he is able to tease out these correlations that are just like mind-blowing. It's these factors that you wouldn't think off the top of your head would have any connection, and yet the correlations are just spooky. So anyways, I'll actually mention one or two of them later on in this conversation, but folks, that's a real treat. So definitely stay tuned for Tom's video coming out tomorrow. All right, so I want to just zoom back up to a real high level for a moment, Lance. So we were talking about how we've largely been kind of back in the era where any kind of news is good news, and then yesterday was a little bit of an aberration, as we mentioned. But we're back to a time that feels familiar if you look at kind of the 11 years leading up to the end of 2021, right? We're just, it's just sort of is the everything was awesome era, right? Everything just kept going up, right? So I want to just ask you to reflect on this. I remember, and you weren't the only one, but I want to get your honest thoughts on this. When the Fed started its rate hike regime, right? I remember as the numbers started creeping up, conversations with several folks, but you included. I remember at one point you saying like, they're never going to get above 3, right? Like, there's just no way this economy can handle more than 3, and it's going to get just so painful that they're going to be forced to return back to easing or cutting again. And they haven't. And here we are hanging out at 5.25, and we've been here for a long time, and we're probably going to be here for a lot longer this year. I'm going to talk about something in a moment that let me put it this way. I agree that if you and I had been told back then that the Fed was going to raise interest rates above 5 and then hold them there for as long as it has, we would have come up with a litany of things that we were absolutely sure of. Oh yeah, the markets, they're going to totally tank, right? Commodities going to get crushed. The housing market is going to sink like a stone, right? I mean, all these things that just haven't materialized. So now that we've got some of the benefit of time here, as you reflect back on that, what do you think?
Well, no, it's if you look at it like in an isolated bubble, right, and said, okay, if everything was status quo to previous periods because of the debt, they would have never gotten above 3 before they caused some type of destruction to the consumptive power in the economy. But the one thing that I missed at the time, in particular, and the one thing that I think that most people are still missing, is the phenomenal amount of money that's been put into the system through the CHIPS Act, the Inflation Reduction Act, moratoriums on, debt payments, just a litany of other supports, expanded child tax credits, extended employment benefits, et cetera.
The size of the pig that was in the python, plus the many pork chops they're still feeding it.
Yeah. It was just so large that, really, we just didn't factor that in, enough as to how much of that money would find its way into creating economic growth. And also, we'd never been through a period where we'd actually just shut down the economy and completely stripped the economy of supply. So again, inflation is always just a function of supply and demand, and we had no supply and lots of demand because everybody had money to spend. And that's actually the subject of our article that's on the website today, which is a recession. The risk of recession is not zero. I love all these memes that are running around. It shows a picture of a cat or a duck or something, and it's like, the risk of this duck murdering you is not high, but it's not zero, right? So, and that's it. Is right now everybody thinks the risk of a recession is now basically zero. And there's still, this issue that this monetary input is reversing and is going to continue to reverse here as we kind of go forward. And we look back at historically at periods where we had very sharp jumps in nominal GDP growth. Early 80s was a good example of this. It took about 22 quarters to eventually get to the recession. And so if you kind of lay out the massive spike that we had, so we had nearly 15% nominal GDP growth. Just, think about that for a moment. We went from a 4 or 5 average GDP growth rate in the economy, nominal, to 15 in basically a year. So in order to get to the recession, you got to reverse that 15%. So you got to go 15, 14, 13, 12, 11, 10, 9, and keep going. And we're still working through that process. That's going to take around 25 quarters. So that puts us into the first half of next year before we really start talking about the results of higher interest rates and the impact on debt and consumption that's going to lead to lower economic growth. And so the whole, we go through.
I'm sorry, was that lag effect you just said? I'm sorry.
Yeah, basically. That is what it is. And what none of us factored in properly, and again, because we'd never been through it, we had no basis to work off of, is, we at that time we were looking back at history going, okay, well, when this happens, it normally takes this long, and the Fed does this, and that gets you to here, and this is what happens. So using all that history is how we came up with that 3% mark. But again, we had no basis to work off of about how large that impact economic growth was and what the subsequent results of that would be. So again, this whole lag effect is taking way longer than anybody actually ever imagined.
Well, I totally agree. And of course, anyone watching this channel has seen the many, many discussions about liquidity over the past, year on this channel. Nobody, I think, I'm not trying to single you out here by any stretch, Lance, but nobody anticipated this. Well, a couple of things. So first off, you mentioned in your article the risk of recession isn't zero. You use a chart in there of money supply as measured by M2 over the GDP, so the M2 to GDP ratio. And I was struck by that because I just mentioned, this interview that's coming out with Tom McClellan. He actually has a chart of M2 over GDP there, and it's time shifted by 12 months. And there's a very strong correlation between that ratio and where the S&P goes.
Right.
And basically what his data shows is when there's a divergence between the stock market and that M2 to GDP ratio, once the M2 GDP ratio begins to turn up again, that's where you get what he calls payback, in the market. That's when the market generally has a correction there. And it's a little too early to tell, but if you squint at the data, that M2 to GDP ratio is ticking up just a little bit over the past couple months. And if that turns out to be a trend, then it would put him on watch for that market correction. And from the timing, it sort of looks like that this would, if it were going to happen kind of near the end of 2024, beginning of 2025. It's just a correlation. He says there's a whole bunch of other factors I'm going to want to look at, but this is one this correlation is held for, many, many decades, and I'm watching it closely. Very interesting to see that you zeroed in on this exact same metric.
Well, well, this is something we've been using for quite a long time to try to understand where we are in the cycle. Really important to understand, though, is that, what most people misconstrue, and again, it's lack of history for most people investing in the markets. Their whole context around a recession is the financial crisis. We're going to have a recession, most likely. No, let me back that up. We will absolutely have a recession at some point. It could be 5 years from now, but we are going to have a recession again, no doubt about it. The question is what's the catalyst, what causes it, et cetera. But if we're just talking about a reversal of monetary input into the economy, it's not going to be a 50% drawdown in the market. It's going to be something more garden variety. I would expect a kind of a repeat of 2022, where the markets are maybe down 20%. And the reason is that, what causes big drawdowns? When people are sitting at home and they're hiding out in cash and T-bills, waiting for the big shoe to drop, you're looking for a credit-related crisis of some sort. And there's no current evidence that suggests there is credit risk in the markets. All you can do is look at spreads to tell you that. Now, could that change? Absolutely. But a normalized recession is not going to cause a credit crisis. You're going to have a very mild recession. Economy will probably slow by 0.5 to 1%. Market will be down 20%, 25% likely at most. And it'll be a great buying opportunity at that point. Interest rates will fall, inflation will reverse. And so you're going to have a great entry point to go long equities on the other side of that. So again, it's just very important to not jump off the cliff and go, oh, recession's coming, and that means, I'm going to lose all my money in the market. I better be in T-bills. That's not what that means at all.
Got it. And that being said, and this isn't in any way to contradict what you said. There's the cat meme.
Oh yeah, this is what got me to spark the article. So,
and it is true. I mean, any cat owner knows that if your cat size and your size were reversed, the first thing the cat would do would eat you.
Probably.
I remember reading an article, the study. Cats are kind of like land sharks to a certain extent. Like they are just very highly optimized predators for their size. And so when you get a cat and you let your cat go outside, if there's not another cat that lives around your local ecosystem, it's like you've just unleashed a velociraptor out there. It's just a killing machine for anything that's smaller than it. Right.
I have threatened for years to get an outside cat and just let them live outside, because whatever yard problem, if you've got, mice or squirrels or whatever's pestering your yard, they will take care of it. So
yeah, they are just crazy. Yeah, they're cute and cuddly, but to your point, if they could, they would take us down. So another thing that Tom said was, this was in relation to another set of correlations. But that looking at those correlations, he is saying, look, the Fed should actually be cutting right now, and they're not, and he sort of understands the reason why they're not, the explanation given for why they're not. He thinks the Fed policy has a lot less influence on inflation than many give it credit for. Right. So the point, though, is saying, which I think is a point I've made, and I think you've made too, is the longer that we hang out at these high interest rates, relatively high interest rates, so the longer we are higher for longer, the longer the lag effect will last once it arrives, right? So if that's true, and we do get a garden variety recession, like you say, yes, it might be garden variety, but it could last for a long time, depending on how much longer the Fed keeps rates at these levels.
Yeah. And again, the higher interest rates, it's impacting the commercial real estate markets we talked about before. It's now impacting hotels. Their refinancing costs are coming up, despite the fact that they've got good occupancy rates. They're running into debt problems because of the higher borrowing costs. So, it's just taken a lot longer for that to work its way through. And higher rates are impacting the consumer. So this chart I've got up is personal consumption expenditures, real GDP, retail sales, and CPI. So this is crucially important. Retail sales make up 40% of PCE, which is 70% of GDP. So PCE and GDP are extremely highly correlated, right? Because 70% of GDP is PCE, right? So I mean, the rest of that 30% can do whatever else it's want, whatever happens to PCE, that's what drives the economy. Retail sales are 40% of that. So you also have a big correlation between retail sales and PCE. retail sales lead PCE by about 6 to 12 months. Retail sales are weakening rapidly as the consumer is slowing down. So PCE is already declining. You could see that massive peak we had in personal consumption expenditures and GDP and retail sales back in 2021. That was all the money. All that's reversing. CPI will track that also, because as we slow down, that's less demand. So as we get more supply as we get less, let me back this up. As we have more supply and less demand, then companies have to start reducing the prices to sell those products. We just saw that with Walmart and Target. They're doing price rollbacks, right? So you can buy stuff cheaper at Walmart and Target. That's going to continue. So that's going to start working its way through inflation calculations. But watch retail sales, because that's the big driver to the overall economy going forward, is that consumption side of the equation.
Agreed. That is the large canary in the coal mine there. And question here about the advanced retail sales line here, the red line. Is that inflation adjusted or is that nominal?
No, that's advanced real retail sales.
Oh, it's real. Okay. All right.
Yeah,
okay.
it's real.
Okay.
The only thing
if it was nominal, I was going to say it'd be even worse, but it's not. That's retail sales, which is still telling a grim story.
Yeah, it is. The only thing on here not inflation adjusted is PCE. And the only reason I use nominal PCE is because it has a very, very high correlation to both real retail sales and GDP and CPI. So it gives you a little bit better image about what's dragging through the economy. But you can inflation adjust PCE and you're going to get virtually the same identical chart. But it's just, you kind of see the magnitude of that surge in personal consumption when we just gave everybody money and told them they didn't have to pay any debts.
Okay, so I just want to note real quick that we just got new jobless claim numbers. They continue to be like tabletop flat. They're not showing any. People look at them the way that people look at credit spreads, right? Hey, we're not having any trouble in the job markets because claims data is still really suppressed. We've talked forever about how we have a lot of skepticism about those numbers, me particularly. I will say, I spent this is anecdotal. Well, it's not all anecdotal, right? So if you look at the layoffs that we've had this year, far more than we had last year at this time. The WARN notices continue at a frantic pace. And yet these claims numbers are super low. We talked, I think, the past two recaps here about how there are factors that make those numbers not super reliable anyways, because the benefits that many people get if they declare unemployment are actually less than if they go get a side gig and all sorts of things. Sure. But this is more anecdotal. But I've now spent a lot of time of late sort of on social media gauging the average person's sense of the job market, and I think I think we can officially now declare it is a tough job market. When you listen to Pal Talk, when you listen to the administration, whatever, they tout the low unemployment. They talk about the job openings per applicant still being very favorable on the applicants' side. You talk to real people and you hear stories of, I just can't get freaking hired. Like, I can't even get freaking hired for, like, in certain cases, minimum wage jobs, right? I mean, there are job freezes, there are layoffs. There's a ton of optical job postings that are there with no intention of ever being filled by the HR managers. So, there's I think an increasing amount of data coming out now that show that the cracks in the consumer are really starting to be visible and to widen. But you and I have said many, many times, the big domino to look at here on consumer spending is going to be what happens with employment, because if that breaks, that is going to really impact consumer spending. And I think the employment situation is very different than what the current accepted narrative is. I think it's much worse.
Well, no, and maybe, here's, full-time employment, year-over-year percentage change. It's a great leading indicator for recession. It's negative now. You don't have negative full-time employment relative to the population outside of that. So, we're seeing there's certainly evidence to support what you're talking about, right? Jobless claims don't really do a whole lot of anything in terms of, managing money or risk or anything else. But again, it's always very important. Remember, you have to separate out two things. What we see and what we talk to, people we talk to kind of in our little universe. And so if I go onto your Twitter channel as an example, and I can see all the people that follow you, and they're all kind of around your same views and opinions. So we're getting kind of one side of the story from your views. So
Sure. Let me just say one thing though. That when I talked about scouring kind of social media, I went deliberately outside of my bubble.
no, that's fine. No, I'm just using an example. Fine. So we go to another channel and we get lots of optimistic views about employment, whatever, right? The market doesn't care anything about that, right? Market could care less. All the market cares about is what were jobless claims. What was the continuing claims number? What was the employment number? So again, it's very important. We can have these views about what we see in our universe around us, about how good things are or how bad things are. The market only cares about the official data. And so just, make sure when you're managing money, you're separating out my personal views, because this is where we get ourselves in trouble. My personal realization, I just lost my job. I can't make ends meet. This world sucks right now for me. It's just everything's gone wrong that can possibly go wrong. This is a terrible environment that we live in, and the market's going up. And they're like, this doesn't make any sense. Why is the market going up when my world is so bad? Because the market doesn't care about your world. The market cares.
Well, two things. One, you may have confirmation bias, right? Where you're seeing things, right? And then your point, the market only cares about the official data. And where I'm trying to put my finger on, and it's more of a hypothesis than I can actually demonstrably prove, but is that the official market data here, or the official data that the market's reacting to here, may be quite flawed.
Yeah, but again, jobless claims aren't a big market driver. Employment is the market driver.
Right.
Right. So that's why you want to take a look at full-time employment as a leading indicator, because that's a good leading indicator. Now, the market only really cares about the official employment report. So as soon as we get into June, we're going to get the employment report for May. That's all that the market's going to care about. If that number came in at 50,000 or at negative 100,000 unemployment, this market's going to go shooting through the moon, because that means the Fed's going to have to cut rates immediately, right?
Which is so stupid, but yeah, okay.
Exactly. So again, I just my point is, I'm not arguing with you on your point that you're making about the employment situation. Absolutely agree with you, because my son's trying to find a job right now and he can't. He's home for college for the summer, wants a part-time job. Nobody's hiring, and he waits tables. So we're talking about restaurants where are normally just happy to hire people to have them in there. There's nobody hiring right now for him. And he's aggressively looking and trying to find. Now, he's only been doing this a week, but I mean, it's anecdotal at this point, but he's not having a lot of luck at the moment. Normally he can get a waiter's job in a day. Right. Normally.
Right.
So we're definitely seeing that. And my whole point is just be careful, trying to make a case for why this market should completely, I'm not even sure why we're rooting for that, but trying to make a case for why the market's going to completely fall apart, because that's not good for anybody. But the market only cares about the official data. So just make sure and separate personal opinion versus official data.
Sure. And all I want to say on this, and I'm not trying to necessarily root for the market to fall apart here, but it's just to say the more I look at the data I can find, the more the narrative about the strong jobs market really seems to be out of touch with reality. And so let's just continue to track. Yeah.
Yeah, it certainly seems to be. I mean, there's a lot of anecdotal data that, to your point, suggests the jobs market is a lot weaker than what the official data says. And at some point, we'll get revisions to the data, and we're going to go, yep, Adam, you were right. The job market sucked starting in 2022, whatever.
Right.
But we won't know that for 3 or 5 years. And 3 or 5 years from now, when they do those major revisions and they come back and catch all that, nobody's going to care.
Yeah, well, part of the reason why I bring it up as much as I do is not because I mean, I do believe that so goes employment, so will go everything investors care about. But it's more on a human element, which is for people who are watching, who, especially if they work for a paycheck, right? And if they're worried at all about their vulnerability, this is ringing a little bit of a warning bell to say, hey, you may want to take steps now to either try to make yourself more essential to your current employer, or if you want to try to make a move, probably make it sooner rather than later, because if the trend of the jobs market is getting worse, your odds of locking something in now are better than if we get into a real recession, right?
No,
Or a real
no,
jobs recession.
yeah, no, there's a lot of studies out right now. Job hoppers are, not getting, but, back in 2020, 2021, you could hop jobs every 3 months and get a higher pay raise. That's not happening anymore, right?
Well,
So
that's why the quit rates have normalized, right? Because the getting isn't as good anymore, right?
exactly. And we're also seeing, kind of other anecdotal things where people are, millennials in particular, and we talk about, as you said, making yourself valuable to your company, those type of things. Millennials are now doing this new trend called quiet vacationing, which is where they are supposedly working at home, but they just kind of move their mouse every now and then while they're doing other stuff, and and schedule an email to go out after work hours. Employers are going to catch on to that sooner or later. So it's great to try to, skim some extra benefits from the company and not really work. Eventually it's going to catch up to you.
Yeah, and to me, I sort of see this as like, first it was quiet quitting, which is like, I don't care about the employer, right? Then it was working two jobs, right? I'm working for two different companies. They don't know it. I'm getting twice the salary. Now you're just getting down to quiet vacationing. Pretty soon it's going to get down to like loud, please, can I just keep my job, right? I mean, I think that's the progress of degradation here, I'm sad to say. All right, I'm pulling up some stuff from later on my list here, but it's because we're on this topic. By the way, the rant I have for today is very much on this topic, so we might even just get there. But we talked about the cracks in the consumer. We talked about the fact that the jobs environment might get worse going forward. There's a poll that just came out that AARP did, which basically says that more than 25% of U.S. adults over 50 now say, I never expect to be able to retire. Right? Which is sad. So that is, you've said many times about how the current system, doesn't work for us, right? We've had all this prosperity, and yet there's so many people that can't come up with, the emergency funds and stuff like that. We're now getting to the point where a quarter of those over 50 are saying, I'm going to have to work until I die. And that's assuming that you can get the work, right? And that's, again, kind of the big thing that I'm trying to drive here. And hey, if we go into a recession, we'll come out of it. So a recession isn't the end of the world. It may actually end up creating better opportunities. But again, the flag I'm just trying to wave for folks is just, if you're in one of these, potentially vulnerable cohorts, which might be, I'm over 50, I don't have as much retirement savings as I'd like to have, and I work for an employer, then you really need to ask yourself, okay, what might you be able to do today to make yourself less vulnerable to a layoff if times get tougher?
I'll tell you what, though, as an employer myself, I will hire somebody over 50 all day long over somebody in their 20s or 30s.
I know, which is culturally a shame.
Yeah, I mean, because
for a variety of reasons.
And look, we just talked about, I have to, with the younger generation, I have to worry about, social, political issues and all the things that are going on in that environment. And, having to worry about quiet vacationing, quiet quitting. One thing I know, if I hire somebody over the age of 50, they're going to show up to work at the office every day, ready to work, no qualms, right? Just that's bred into them. So, if you're younger and you're competing with older workers, you might want to get your game on.
All right, so let's go straight to the rant then. I'll come back to some of these other things if we have time. And part of this was inspired by my recent interview with Nicholas Eberstadt, who wrote the book "Men Without Work: The Silent Crisis We Have in America." And we've talked about this a bit in the past, Lance. So from Eberstadt's work, there are now, I think, over 10 million able-bodied working age adults who have checked out of working, who just said, you know what, I'm just not going to work, right? And it's not for good reasons. It's not in the long-term interest of these people that are checking out. It's not in society's long-term interest. It's a very sad story. People are generally checking out for demoralization reasons, and then they get trapped in depression and addiction, largely addiction to both pain medications. So half of these 10 million people self-report being on pain meds. And then their screen time is through the roof. So they've got digital device addiction, right? So we can talk more about that in just a minute. The only other thing I want to note on that is when Eberstadt wrote his book, Men Without Work, that came out in 2019. So all this predated all the craziness of the pandemic. He said that the number's grown out of 10 million, and it's now 7 million men and 3 million women, saying we're beginning to see an alarming trend in women in the same thing, right? So we'll get back to that in just a moment. But I was watching an interview the other day, and the commentator said something that really stuck with me, and I sat down and told my kids about this. And this is something I've thought for a while, and Lance, you and I have talked a little bit about it, but he said, we've really sold a bad bill of goods to the past two generations, millennials and Gen Z. He said, we basically told them that the 20s were a time for like sucking the marrow out of life and getting out there and experiencing it and being free and not really getting serious about your job until you get to 30. And that's when you really start to like figure out life. And he's like, no. He's like, that period of time to suck the marrow, that's like your 70s, right? Like that's right when you've earned the ability to do that. He said that your 20s are when you're supposed to be working really hard to develop the skills and the financial foundation that will carry you through the rest of your life and enable you to retire. It's a lot of hard work. And thank goodness you've got the stamina and the energy of youth, to be able to make it through all that, because it's tough, right? And if you're starting a family and all that, there's a lot going on. And thank goodness you're young and have the energy to do it then. And I think it's very true. And you see these videos online of these super frustrated, it's now mostly Gen Zers, but I know millennials, feel the same way, where they're just super frustrated that they've got the degree, but they can't find a job, and they spent a year or two doing something that was, finding themselves, but they're now realizing the reality of but I actually have to eat, and I have to be able to have a roof over my head, and it's gotten so much more expensive, and I'm now beating the pavement, hand delivering resumes for minimum wage jobs and basically getting no callbacks. And so, there's a lot of cultural reasons why I think didn't give these kids enough of the guidance and maybe the discipline to be the type of employers that you'd prefer to hire, Lance. But we also have, we've allowed I think a detrimental fantasy to breed in them about how life should be, and they're really beginning to realize that no, this doesn't map to the real world.
Yeah, no, this is it's a very true statement, and the thing is, where we went wrong as parents to the current two generations, so both Gen Z and millennials. This is all Gen X and Boomers' fault. But what we did was say, okay, hey, look, go to college, get a degree, and when you graduate college, then you get into the work environment. Well, what we didn't tell them is that unless you're getting a very specific degree, like mechanical engineering, chemical engineering, petrochemical engineering, whatever it is, or an accounting degree, that very likely your first jobs are going to have absolutely nothing to do with your degree. And that was the case. I have a double degree from my college. My wife has a degree from her college, and neither one of us worked in and I still don't today. I've told you this story before, that when I graduated college, my whole goal was to be a middle manager at Coca-Cola Enterprises. That was it. I wanted to work for Coke. I never got close to working for Coca-Cola. So, but
and just to let you know, you're talking to a guy who was an archaeology major who took pre-med classes because he was going to be a doctor, and now I do financial videos. Yeah,
exactly. And so, what we didn't educate our kids about is, look, what do you learn in college? All you learn in college is really two things, right? How to show up every day and do a job, and then go find information. Somebody says, hey, go learn this, and you go find the information for it and you learn it. That's all you learn. And so when you get out of college, you get a job, and the employer says, great, you've showed me that for 4 years you can show up and do a job, and that you can go seek out information. So I'm going to put you to work. Your job is to show up every day. I'm going to give you a task. You go figure out how to do it. That's what employers do. And it doesn't matter what your degree is in. If you have some degree that's not industry specific, again, if you have an engineering degree and electrical engineering, you're probably going to work for an engineering firm doing electrical engineering. It makes complete sense. If you're an accountant, you go to work for an accounting firm. But if you have a degree in archaeology or in finance or in other sociology or whatever it is, odds are you're not going to get a job in that field, right? I was talking to a young person the other day, has just graduated, has her psychology degree coming out of college, so it's a bachelor's in psychology, and very frustrated. Same point, right? Nobody's hiring, and I'm a psychology. I'm going to go work in the psychology field. I'm like, you're probably not going to touch it with a BA. You're going to have to, you got to be a PhD ultimately to do that, and so you're going to have to get a job doing something else, and you're going to get experience doing that. But the reality is that a lot of people in the world, they go to college, they get their degree, and then they wind up doing something totally different. They become talk show hosts for financial video channels. They manage money for a living. This is not what I went to school for. I fell into it by complete accident through people I met when I was fighting overseas and doing martial arts overseas and competing. And I met people in the finance and banking industry. And I'm like, oh, there's an opportunity. I'm one, when the door's open, I'll jump right through it, right? So forget the open window. I'll take doors all day long. And so I got into managing money completely backwards. I didn't go to I didn't start out on Wall Street like a lot of people did in the finance industry. I started out totally different. That's why my views about managing money and risk is very different than people that grew up on basically went through Wall Street, right? Because I just have a very different background of how I got here. And so, I think it's important that we educate, and this is what I tell my kids, every day. Look, get a good degree, something that gives you a skill set to work with, and then go find your first job. And it may be, working at a grocery store, right? But you learn. And then from there, you keep finding new opportunities, and eventually you stumble into something that you absolutely love. And it may have absolutely nothing to do with what your skill is. My wife went to work went to college, got her degree. She was a nurse, graduated college, nursed for many years, worked her way up through the ranks in the hospitals. She sells natural gas now. It has nothing to do with nursing. She loves her job. She's developing, she works with companies like Carnival Cruise Lines to load liquefied natural gas on the cruise lines. She absolutely loves her job. She's making a killing doing it. Has nothing to do with their degree, right? And that's the thing that I think we need to instill in our children is don't be so focused on what your degree is, when you get out. Focus on a job that gets you started. And then from there, you can find your path to what you love doing.
So I totally agree with that. And I actually have some thoughts here on, not just complaining about the problem, but things that people can do, whether you're right out of college or whether you're unhappy with where you are right now and you want to switch to something better. Because I've been in both cases, graduating and wondering what the hell I was going to do with my life. And then also, being in a track for 20 years and saying, is this all there is? I don't want to be doing this the rest of my life. But I do want to say that this cohort of younger generations does face some unique, uphill battles that previous generations didn't have. One, I think, employers have woken up for a good while now to the fact that humans are expensive to employ and they're messy, right? And so they've been for several decades, they've been trying to find ways to employ fewer human workers and definitely fewer domestic human workers, right? So outsourcing, automation, now it's going to be AI, right? We also have this huge cohort of old people that can't afford to retire, right? And so your experienced base is going to hang around for longer. So the slots, we're reducing the number of spaces, and then they're coming up for availability less. And I went on to Wall Street, and I was fortunate to have, I had to work my butt off, but I did break into an analyst class, like when these companies come and hire from colleges, right? And I was able to convince some recruiter why they should take a a flyer on an archaeology / pre-med student, right? And I was totally a square peg there, fish out of water, which it's interesting. So I did start my career on Wall Street, in the official like entry process, but I was sort of like I was different from everybody else. So I looked at it, I think, from a very different perspective, and which is why the culture was never a good fit for me. And when I left, I left it with a sense of, wow, Wall Street really looks out for itself, not for its clients. And that sort of birthed the mission of what eventually has become Thoughtful Money, right? It's trying to look out for the client.
Yeah. And that's the thing, right?
But we don't have those. Coke, they've got a massive management training program, right? That if you get accepted and coming out of college, there's a development track that you go on, right? But those are becoming less and less, right? So a lot of kids are finding themselves out there with, I got this paper degree in gender studies or whatever, and nobody wants it. And it's hard. All I can do at this point is apply for what job is on the website, which we all know 1 billion people apply for, and nobody gets it because they're not looking to hire for it anyways, right? So they understandably, it's tough. That's what I kind of want to acknowledge here, is that we've sort of sold them this fantasy that doesn't work out, like I was talking about earlier. I think they have these attitudes around work that don't make them appealing in general, right? And we've allowed that to foster as older generations. And then third, they have these conditions that just make it tougher, right? So, now that I've sort of depressed every Gen Zer and millennial watching this, it's not the end of the world. So here are the things that I think could be really useful to keep in mind. But go ahead.
Before you jump off that, because again, we have to go back to something that's crucially important to the current dynamic, which is back in the 30s and 40s, most people didn't graduate 8th grade, right? And then in the 60s and 70s, we said, okay, you have to go through high school and graduate with a high school diploma. Then everybody had a high school diploma, supply and demand. Right. When everybody has a high school diploma, it has no value. And so get into the 80s and 90s, you went to college to get a bachelor's degree, and there weren't that many people with bachelor's degrees at the time. Everybody had a high school diploma, so you couldn't really get a good job with a high school diploma. You had to have a college education. Then the Obama administration comes along, takes over college student loans, says, and then we start this whole thing that everybody's got to go to college. Everybody needs to go to college, have a college degree. Now everybody's got a piece of paper that says they're from a college. It has no value because everybody has one. It's now the equivalent of the high school diploma. So now if you want the job, you've got to go to master's, get your PhD to make yourself stand out. And then, so this is a supply demand problem. Right now, we don't have, and this is one of the huge benefits of AI that's coming. I've got an article coming out next Friday talking about the economic benefit of AI. What is coming down the pipeline is that the millennials and the Gen Zs in particular are going to have massive opportunities in trade skills because we don't have trade technicians. We need people that can run cable, lay concrete, build buildings, build structures, those type of things. And then, of course, on top of that, you have the engineers to design them. So, if my kids right now, and I had this conversation with my son yesterday, I go, forget about everything else you're studying. Either you study how to be an engineer to build something related to AI, or you figure out how to program and train AI, because that's it. That's those two jobs you're going to have available coming out of college. But the opportunity for trade skills going forward is now where we were back coming out of the high. Everybody has got to have a high school diploma. Nobody had college degrees at that point. We do not have that many people with trade skills. And that's going to be a massive job opportunity for people to make a lot of money going forward. So forget college, go get a trade.
Yeah, I agree. And we've talked about this before, and you can see it. I mean, you can look at tradespeople these days and say, these guys are making a great living, and in a lot of cases, have better work-life balance than a lot of high-paying white-collar jobs that end up not being that much more high-paying, or sometimes even less, right, than someone who's really successful at a trade. Certainly a trade guy that ended up, kind of like, owns the company and now employs other tradespeople under them, right? So couple of things, and I'd love to have you editorialize on anything that I say here, Lance. So a couple of things. First off, you're going to need to shift your mindset a little bit, right? Which is we tend to be so driven around money and earnings potential, right? And obviously, we need to make enough to feed our families and keep a roof over our head and all that type of stuff, right? And cost of living's going up, so I'm not trying to diminish the importance of money, but I will say when it comes to work, um, you really should try to focus on finding meaning in the work itself. As we talked about, Lance, many times here, the three things that really matter in life, and this is what the 100-year-old people tell us, is quality of relationships, purpose, that your life had some meaning that you cared about, and health, right? So we talk about health a lot. But purpose, and just, they say follow your bliss, follow your passion. If you can, great. But studies have shown if that's your only guiding light, it can often end in sort of unrealistic expectations and decision making. And if your passion is something that can't be monetized, that can make life kind of hard, right? But if you find something that you think makes a difference in the world, that you are good at, and can develop mastery in over time, you find a lot of personal validation in the process itself. And even if you don't become a gazillionaire doing it, it's a fulfilling life. And at the end of the day, that's really all that matters, right? And so where I'm going with this is, if you find the joy in the value creation process, you're leaving the world a little bit better at the end of every day. And if you're creating value, somebody's going to pay you for it. And value accretes. And as a capital manager, you know this really well, Lance. But I'm going to pull up an image here that just shows the difference that even just a little bit of accretion over time can do. So bear with me 1 second. I'm just having trouble pulling it up here. All right. So this chart is going to compare compounding something to a factor of 1 versus compounding it to a factor of 1.01, right? So if you take 1 and you multiply itself over 365 days, so 1 to the 365th power, it's only 1, right? You're just 1 times 1 times 1 times 1, right? But if you take 1.01 and you factor that to 365th power, it's 37.7. So basically, if you just make yourself 1% better every day, if that's your focus, right? It's like, I'm not going to try to double my productivity or my abilities tomorrow. I'm just going to make them just a little bit better. And I'm going to try to make them just a little bit better every day. The difference between basically no improvement and just a little improvement becomes tremendous over time. You're making some interesting faces as I'm saying this, Lance, so I'll take a pause.
No, I mean, it's right. This is, what we talk about all the time. This is why, every day it's about, and doing something to increase your education, figure out something to do to improve your overall health. Whatever it is, if you want to progress, you've got to do something to improve every day. If you just kind of wake up and do the same job every day, come home, put in the minimal effort. And this is the thing I think that is going to come back and bite, the younger workers kind of in the butt down the road, is this whole idea of quiet quitting and quiet vacationing and all these type of things. It sounds great for right now. It's like, I'm taking advantage of my employer and I'm making money. I'm not really working all that hard. It's going to catch up with you because, again, you're not improving yourself. If you show up for work, you go to the office. And this is the one thing that I think is really going to impede the younger generation that wants to do everything remotely. I want to work remote. I want to be at home. You lose so much of being at the office and interacting with your peers who have more experience than you. I mean,
Right.
my biggest learning was not in college. I worked for a guy who, for a few years at one point, that was a developer, and he developed, that big sail out in Dubai, the kind of the Cell Hotel.
The big building, yeah.
Yeah, he was one of the original builders of that. So, and designers of it. So I learned a tremendous amount of business and things about how business works from him. And just by being around him, you kind of absorb it by osmosis and watching how they work and doing this. And you lose that when you isolate yourself working at home. Even if you don't appreciate your coworkers, they'll teach you stuff, right? Because they've had some experience or some event has happened to them, and they can say, "Oh yeah, I did that before. You shouldn't do it that way. You
Right.
should do it this way."
We
And then
know
say,
the
"Oh,
most successful educational model for skill development, right? It's the master apprentice model. And the
yeah,
master apprentice model usually starts with the apprentice merely observing the master for a long period of time before the official education even starts, right? Because there's so much you learn from watching somebody do it right.
that's right." And I think we're really kind of cheating. This whole look. I get the whole remote work from home thing. I get it, right? But I think we're really not helping our youth by accommodating that. I think it would be much better if we said, no, you need to come to the office. You need to work around other people, because that's also where you're sharing ideas and innovating. And I was talking to my son the other day because he really wants to work for himself someday, and I'm like, yeah, you should. If you want to build real wealth in this world, you have to own your own business. That's how you build wealth, right? You're not going to do it by just saving and investing in the market. If you want to build real wealth, you have to own your own business. And and I said, you can't just walk out of college and start a business. You need to go work for somebody who's in business and watch how they run their business and learn the right things that they do, the wrong things that they do, what works, what doesn't work. And when you're there, that's also, you go to work for somebody like Nvidia, right? And that's where, by working at Nvidia and seeing how Nvidia builds their GPUs and AI and everything else they're involved in, you go, you know what? I see how that's done, and I can see an opportunity to do something a little bit better. That's where those ideas come from. And so you've got to, that's the part that we're depriving our youth of, that's actually hurting them in the long run.
Absolutely. And you mentioned something that's very important there, which is there is discovery of how to do things, right? So you're learning, oh, this is how it's done. And now that I know the formula, maybe I can go do it on my own or improve it myself, right?
Yeah.
But then there's also negative discovery, right? So much of this is saying like, whoa, I thought I wanted to do that. Man, now that I'm doing it, I hate it, right? So let me just get off that track, right? Or like, oh my
Yeah.
gosh, that business is making a stupid mistake. There's just opportunity lying on the ground here and they're not going after it. Man, I'm going to go after that, right? So it's both the positive and the negative discovery. So, all right, folks watching this took a little bit of a longer track than I thought it would. I'm going to get to Lance's recent trades in just a minute here. But in wrapping up, so I've got a daughter like you've got kids that are starting off in life. And it's really interesting where, I've been talking to her about this stuff forever, right? And, in one ear, out the other, doesn't want to hear it. I totally get it, right? I didn't want to hear it when I was that age. And then now that she's out in the world, all of a sudden the phone calls have started, which is like, hey, wait a minute, Dad, that stuff you were talking about. Can we talk about that again for a minute here? Yeah. And so it's been interesting to see, like you said, what she ends up doing may have absolutely nothing to do with what she studied in college, right? And I understand that that can be sort of demoralizing for people when you feel like, oh my gosh, that's just wasted time, and am I starting from complete zero here and whatnot? So here's some advice I've given her that I think is useful to, again, people starting out or people looking to switch careers. First thing is create a draft plan of what you think you want to do, right? Like for her, I'm just like, hey, what do you think you might want to do? What type of industry, what type of work do you think you want to be doing? Spend some time thinking about it and then just put it on paper. I want to be doing that in 5 years, right? May happen, it may not happen, but now you've got a plan, right? And it's so much easier to evolve an existing plan than a blank sheet of paper, right? If you've got a compass with no compass points on it, how are you going to know what direction to go in, right? So then you start networking and informational interviewing like crazy. You just start talking to anybody who has any potential connection to this draft plan you've just put together. And at this point, you're not necessarily looking for a job. You're literally just trying to understand how this all works. What's it like in this industry? What would I be doing if I had a job like this? How would somebody get started, right? You're just sponging all this stuff up, but also more importantly, you're getting on the radar of people who have influence, right? So all of a sudden, these people are saying, oh, here's a bright, shiny person who seems to be interested in this. I had a call with them. They seem really nice and energetic, right? And that's where, one, they're investing in you by imparting to you their knowledge, which is tons of value. But as you start looking for jobs, these are people who might say, oh, you know what? Like, yeah, I talked to Lance and he seemed like a good guy and he was interested in this. I'll vouch for him. Or, maybe at their company, there's an open job opening and they'd be the one to refer you to the hiring manager. Or maybe they don't have anything right then, but in a month, their division starts hiring and they're like, oh my gosh, I just talked to that great guy, Lance. Let me give him a call and see if he seems like he'd be a good fit. You begin to create the opportunity for serendipity to come into your life.
And I cannot tell you how important that is, right? And it's just to your point, you said this earlier, and I wanted to stop you here because what you're talking about is incredibly important to younger people. And I just had this conversation with my son 2 days ago because he's online applying for these jobs, right? And I'm like, son, you're never look. I said, you put your resume online. It's a great resume, had it professionally written, right? It's a great resume. You're in there with 10,000 other people. I said, you figure out a way to go over there and meet the manager and shake his hand and say, I would really like to work here. When we hire in our firm, we don't hire through resumes ever, right? Where it is relationships that we have with other people. And it was like when we have a spot for an advisor come up that we need an additional advisor for the firm or whatever, or we need client service help or whatever it is. It's like, oh yeah, I know the perfect person for that. They are dynamic, they're outgoing, and we have an awesome team at our firm. They're great people and they all work great together. But nobody got hired off a resume because you don't know who that is. And when you're in a pool with 10,000 other people, there's nothing for you to stand out. So to your point, Adam, it's a different world. This, when you and I were coming up, everything was face to face for the most part. And, if you wanted to apply for a job, you went to the company and you figured out a way in the door to meet somebody to try to get a job. It's not that way anymore. So we've got to be a lot more creative as youth about how to get in front of the people making those decisions so that when they're looking at 10,000 resumes and scanning them with a computer and trying to get that down to 100 to interview, you're sitting at the top of their mind going, you know what? Adam showed up here and I met him. He seems really nice. I think he'd be a great fit. I'm going to give him a call and have him apply, right? But you've got to create that opportunity to get in front of somebody that's making those decisions. And what you're talking about is so important for that.
I'm so glad we're in agreement with that because I totally agree. I would actually say this has always been the way that it's really worked.
Yeah.
For the things that I where I succeeded, where things were highly competitive, whether it was getting into an Ivy League institution, whether it was getting on Wall Street, right? Yeah. It's not the front door. You create a side door, right? And that's the big thing that I've been telling my daughter, and sort of exactly what you're saying there too, which is like your odds of getting into the front door are extremely low, and I think getting lower in the world of less need for real humans and AI being the screener for everything, right? Yep. So you need to create your unfair advantage, which is, hey, I've developed a personal relationship with an influencer, a decision maker, because I have taken some proactive additional steps that have self-identified me in their mind as an extraordinary candidate. Right? So that's what you got to do. So another way to do that is project work, right? Because at the end of the day, people really don't care. They don't care where you went to school. They don't care about your degrees and diplomas, unless they have to, right? Like, okay, if you're a doctor, you had to have gone to medical school, right?
I hope so.
Yeah. But otherwise they don't. It's just like even a programmer. I don't care if you went to Stanford or you're self-taught. Just show me what you can do, right? Can you build what we need you to build, right? So what you need to get for currency is experience, right? And so a lot of people have the issue, well, I can't get hired, so I don't need experience, but I can't get experience if I don't get hired. So part of this, again, is creating your side door, which is to say in these informational interviews, hey, you know what, like, I'm so interested in this space, and I would be happy to do some work for you for the next month for free, right? And maybe it's only an hour a week, 5 hours a week, whatever. If you're young and scrappy and can couch surf, say, look, I'll just work for you for a couple of weeks, 40 hours a week for free, right? But the thing is that hard for a company to turn that down for a bright, shiny candidate, especially if it's not essential work, but it's some work they'd like to get done. If you do a good job, then the company actually gets to kick your tires and say, hey, this guy's actually really good. Let's try to create an opportunity for him. Even if we weren't planning on hiring, he's identified himself as good. Let's bring him in. But even if not, you now have marketable experience. So in your next conversation with somebody, you can say, oh, yeah, actually, I just did this type of work for one of your competitors. So yeah, I actually really know what's entailed here, right? It is a great catalyst. It's a force multiplier for your attractiveness to an employee. So I know people hate to think of it, but doing project-based work, even if you got to make it free, is, I think, incredibly valuable in the process. It also lets you get your hands dirty and answer the question, do I really want to be doing this, right?
Yeah.
So I talked about, that initial draft plan you created. Well, as you're having all these conversations, as you're doing this project-based work, then you're evolving the plan, right? Oh, I like this more. I talked to this guy and I thought I wanted this type of job, but he mentioned this other one that I didn't even know existed, and that's way cooler, right? So you're refining your being. You're now creating a much more laser-driven path to where you want to go. Then you take the network of everybody you've talked to, and then you mine it to create those side doors to that refined vision that you've had. Because you can now go back to them and say, hey, thanks so much for talking with me 3 months ago. Man, you were so influential that I went and did X, Y, and Z and learned, A, B, and C. And now I really know I want to do this. Is there anybody that you can refer to me to in your company, elsewhere in the industry, who might have work that's a good fit for my now very specific plan for myself, right? So you're enabling them to help you better, and you've impressed upon them that this is something you're very serious about. They've seen your evolution. They're going to be a champion for you and try to help you. And the more people you have being your champion, the better your odds of getting placed. So, anyways, you go through all this, you have much better chances of getting to a good destination that's a good fit for you and much better odds of actually getting there. So even though Lance and I are talking about how tough environment, rough world out there, and honestly, I think it's going to get even tougher as recession eventually arrives at some point due to this lag effect. If you're following the steps that we've just laid out here, you are likely going to be in much better position than the vast majority of other people out there desperately trying to get hired.
Yeah, no, that's right. And look, and when you do, if and when you do have a recession, that's going to be your moment to have opportunity, because companies will lay off employees, and then the recession will be over, and they're going to look to hire back employees. And the employees they laid off may have gotten a job somewhere else, so it doesn't mean they're going to hire back exactly the same people they laid off. So job opportunities are going to open up as companies start to ramp back up again. So, again, recessions are a good thing because it creates opportunity. And you should look at recessions going, oh my gosh, it's going to be, it's going to be this terrible thing. No, it's not. And, it'll be something that creates a lot of investment opportunity, but also creates a ton of job opportunities as well.
It does. Although I do want to be real, recessions when your neighbor loses your job, it's a depression when you lose yours.
Yep.
So you want to be taking the steps now to minimize your chances of getting laid off. And if you're having to go job hunt in this environment, man, if you're able to actually get a job during and interestingly, I've gotten most of my jobs in recessionary times. And it was not easy to do so, but it placed me in a really good position for when we came out of recession, because I had recent experience that was now in very high demand. So anyways, I hope other people follow that. All right. Sorry for the long detour there, folks, but hopefully that was useful for younger people watching this, people that have younger adult children that are going out into the world, or those of you who are looking to, like I said, switch to doing something more meaningful for you. All right. So in wrapping up here, Lance, they'd shoot me if we forgot to do your trades. What trades have you guys made recently?
We didn't forget. We talked about it. We trimmed Nvidia back in April, and we added back to it. We trimmed it back in February, added back to it in April. And so, this week has really been just kind of watching that kind of come to fruition. So really, we didn't do a whole lot this week.
Okay. And looking towards next week, is there an action plan, or are you going to more react to what goes on in terms of portfolio changes?
Mostly just, at this moment, the market's doing fine. There's nothing really on the horizon that suggests that there's any reason to be overly concerned. And, again, I know there's a lot of this, economic data we can pick on and say, this is bad economic data, this is bad. And, I don't know why we're rooting for a recession, because we shouldn't be. It's not good for anybody. But, if you're out there, wanting or expecting this major market crash to occur, that's not, maybe you'll be right in the investment market. So you can go beat your chest and say, see, I was right, the market crashed. It's not going to really matter, because, you're going to take so much devastation elsewhere in your life. It's not going to make much difference. But, the reality is that, yeah, at some point, this economic data is going to catch up. We're going to slow down. We'll probably have a mild recession at some point, and that'll be a great opportunity to put money to work. So, it's important to kind of look forward and say, this is the cycle that we're going through, and there's going to be some great opportunities along the way. But that's still probably, a couple of quarters, 3 quarters away before we start to see any real kind of weakness in the overall market, at least for now. Because again, there's nothing sitting out there that suggests that a big downturn is right around the corner.
Yeah, and getting back to the Tom McClellan interview that's going to launch the day after this one. So Tom has some of these correlations I mentioned that suggest that if the correlations hold, the markets will go through some sort of correction either in the second half of this year or the first half of next year. So he's sort of on alert for them, but the indicators that he looks at that will tell him that some sort of correction is likely to be coming soon, he's not seeing those indicators. So right. To your point, he's looking at it, he's like, hey, like I'm looking for these different types of divergences, and we're just not having them yet. So, yeah. Again, who knows what the market's going to do tomorrow, but he's like, we're just not seeing the signs that a near-term reason to worry is there.
Yeah, no, and that's right. And you always got to be careful with correlations, right? I mean, because there's a huge correlation between the number of people that eat chicken and the number of people that die by getting tangled up in their bed sheets at night while they're sleeping. They don't, there's so just be careful with correlations. Yes, historically these things have occurred, but it doesn't always mean they're going to occur in the future. So it's important to pay. My point is that these correlations that he does talk about, we do a lot of the same correlation analysis in the work that we do. But one thing we always say is these correlations held historically, but this time, because of what happened in 2020, because of that shutdown, because of the massive stimulus, a lot of those historical correlations have gotten broken, and it may take another decade before they start working again, because we got to work all that excess out of the system, and that just takes a while.
That's very, very true. And yeah, correlation's not causation. And we do have the I sort of think of like the snow globe effect of the pandemic, where it took a lot of the things that worked a certain way and just totally jumbled them, and the snowflakes are still falling, so we got to wait for everything to sort of settle out, right?
Yeah.
Yes. So no, totally agree. And really, what I was just trying to say is even though we sometimes spend focus on what could happen, and certainly we've been talking a lot about recession this time around, even those looking for it aren't seeing the immediate warning bells. So this is not necessarily the time to just say, oh my God, I'm so worried about all this, I just got to get out of the pool. And I want to underscore something that you say a lot, which is, look, the thing is not to be right about any one particular thing, right? The goal here is to make enough money at a sufficient risk level to hit your life goals, right? That's what winning is, right? So whether there's a depression or not, you want to be looking at the big picture to say, okay, how do I need to avoid, what risks do I need to avoid, and where do I want to be leaning into risk? And because to invest, you have to take on some degree of risk. Where do I want to be leaning in so that I can hit the goals that I want to hit in life on the timeline that I want to hit them on, with enough risk management that I can sleep at night, right?
Absolutely.
All right. So wrapping up just real quick, I just want to let folks know what to expect from the talent that's coming on this channel. We've got some pretty big next couple of weeks. I've got behavioral economist Peter Atwater next week. That's being followed by an update on the auto industry. Been getting a lot of requests for that for a long time. We've got Jim Grant coming up, Ted Oakley, Dollar Milkshake guy, Brent Johnson, Doomberg, Michael Kantrowitz will be coming on. Sven Henrik will be coming on. Fred Hickey, high-tech strategist, he's coming on, followed by Matt Peipenberg. So I just want to let folks know that we've got a very great pipeline of talent coming up over the next couple of weeks. So stay tuned. Also, if you've enjoyed Lance and I kind of going extra off the rails today, would like to see more of that in the future, please let us know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Please help us hit that 100,000 mark too. So if you normally watch and don't subscribe, think about doing it now if you can. Just a reminder for everything that Lance and I talked about, if you'd like some help and some guidance from a good professional financial advisor, I think you should, the vast majority of people watching this, unless you've got a great track record of being a successful do-it-yourself investor, everybody would benefit from that. But as I like to say, when you put those requirements together, professional, good, and then takes into account all the macro issues that Lance and I talk about, the universe of advisors that are able to do that actually becomes quite small. If you've got a good one though, if you've got one of the ones that fits in that Venn diagram, great, stick with them. If you don't, or you'd like a second opinion from one who does, consider scheduling a consultation with one of the advisors that Thoughtful Money endorses. To do that, it's very simple. Just go to thoughtfulmoney.com, fill out the short form there. While you're there at thoughtfulmoney.com as well, that's where you can sign up for our free newsletter by clicking the newsletter link at the top. And just letting folks know who are premium newsletter subscribers that this week's Macro Pass is a great article about mortgage default risk from Melody Wright. So you'll find that there. All right, Lance, as usual, my friend, I'm going to give you the last word.
Nope. Y'all enjoy have a very happy Memorial Day. By the way, let's all remember the difference between Memorial Day and Veterans Day, right? Veterans Day in November, we celebrate our living veterans who have served and fought for freedoms and are still alive today. And so we certainly want to pay our honors and respect to them. Memorial Day is for those that have fallen in battle, to give us our ability to say and do the things that we want on social media, to have that freedom of speech. And so, tomorrow on Monday during the holiday, while you're having your barbecue and enjoying your family and friends, don't forget to take a moment and just pay a little respect to the men and women who have died in service of providing the freedoms that we enjoy today. Even though we're trying to get rid of them as best we can, they certainly fought for them.
Well, very, very well said. I'm glad you brought that up. And the only thing I would add to that is reflect on how to best honor that sacrifice when it comes, the election comes up in November. And I'm not encouraging people to vote one way or the other, but I'm just saying, for your own personal self, ask yourself, what freedoms do we enjoy because of the sacrifice of so many that you really want to make sure we protect going forward, and make sure that you make that clear in the voting booth, which freedoms you care about most.
Yep, absolutely. All right.
All right. Lance, my friend, thanks so much for doing this for another week. Everybody else, thanks so much for watching.